All right, so, you flagged up this thing with director's loans where you can sometimes end up with some, pretty nasty tax bills if you're not careful. And today we're going to sort of unpack that and go deep on a really interesting strategy using interest charges on director's loans in the UK. It's kind of a clever way to unlock some pretty significant tax advantages.
Yeah, absolutely. It can be a bit of a minefield if you're not, totally up to speed on the rules. But the stuff you've sent over from HMRC and some of those real world case studies is really fascinating. And what we're going to try and do in this deep dive is pull out those actionable things that could, really make a difference in how you handle director's loans.
Okay, so let's kick things off by making sure we're all on the same page. For those who might be newer to this whole thing, what exactly are we talking about when we say director's loan? Can we break that down in simple terms?
Basically, it's when a director of a limited company borrows money from that company. So you're essentially taking a loan from your own business.
Right.
And there's this kind of magic number of £10,000
Right,
that
yeah.
you need to be aware of.
Got it.
If the total amount you owe the company goes over £10,000 at any time during the company's financial year, that's when the tax man starts to take notice.
Okay, so that's the thing we want to avoid, I'm guessing.
Yeah, you really do, because if you go over that limit, that's when you as the director can get hit with income tax and national insurance contributions on the amount you owe.
So that's the potential downside.
Yeah, that's the catch.
Okay, but in all this stuff that you've been looking at, HMRC's official rate of interest comes up a lot. What's that all about?
So HMRC sets this thing called the official rate of interest, or ORI.
Right.
And right now it's 2.25%.
Okay.
And here's where it gets kind of interesting from a tax saving point of view.
Right.
If the company charges you interest on the director's loan at that 2.25% or higher, it basically wipes out what's called a taxable benefit in kind, or BIC.
Benefit in kind. I mean, that sounds like something out of a tax textbook.
Yeah, it can be a bit jargony.
Can we just put that in plain English for a sec?
Yeah, so just think of a benefit in kind as like a non-cash perk that you get from your company.
Right.
That has a monetary value.
Uh-huh.
In this case, if you've got a director's loan and you're not really paying much or any interest on it, HMRC sees that as you getting a benefit.
Okay.
You're getting to use the company's money essentially for free
Yeah.
or on the cheap. If you charge yourself interest at that ORI or above, it's like you're saying to HMRC, hey, look, there's no freebie here.
Okay. I think I'm starting to get this.
Yeah.
So by charging that official rate, what's the upside for me as a director apart from, keeping HMRC happy?
The big win is that by getting rid of that benefit in kind,
Yeah.
you wipe out the income tax that you as the director would have had to pay.
Right.
And the company avoids having to pay employers' Class 1A national insurance.
So both sides win there. Okay. And just to be super clear, that HMRC rate, we need to keep an eye on that, right? It's not like it's fixed forever.
Exactly. That's super important. It can change, so you got to stay on top of what the current rate is.
Got it.
To make sure you're applying the right one.
All right. So in everything you've been reading, it really pushes the tax advantages of charging interest. I mean, is this really like a win-win situation? It sounds almost too good to be true.
Well, it often can be. It's this kind of neat double benefit for both the company and the director.
Okay, so first from the company's side, how does this work out well for the business?
Any interest that the director, pay back on that loan, that becomes an allowable expense for the company.
Right.
And what that means is it brings down their taxable profits, so they end up paying less corporation tax.
Okay, that makes sense.
In the example they give, the corporation tax rate is 19%.
Right.
So for every bit of interest you pay, the company gets a tax break.
So that side's pretty straightforward. Now, what about me as the director, aside from, dodging that benefit in kind tax? What's the advantage there?
It can actually be way more tax efficient for you to pay interest on the loan than just taking the same amount out as dividends, especially if you're a higher or additional rate taxpayer.
The example they give puts some numbers on this. Can we run through that quickly just to, really see how it works?
Definitely. So let's imagine you need £10,000. If you were to take that out as a dividend, and the example uses someone who's a 40% taxpayer, and the dividend tax rate for that is actually 33.75%, you'd be paying £3,375 in tax on that dividend,
Yeah.
leaving you with £6,625.
Okay, so a big chunk of that 10 grand has gone straight to HMRC.
Yeah, nearly a third.
Right.
But what if you use the loan approach?
Right.
If you went with the loan and your balance was over $10,000, you'd be paying interest at that HMRC official rate of 2.25%
Yeah.
on the outstanding amount. Now, let's say it's a 10,000-pound loan that just sits there for the whole year. Bear in mind that the actual calculation can be more complex, if the balance goes up and down.
Sure.
But in this case, your total annual interest payment would be £225.
225.
Yep.
Okay. And how does that look from a tax perspective?
Well, you've paid the $225 in interest, and because you've charged at least the ORI,
Right.
there's zero benefit in-kind tax for you.
Right.
Now, from the company's point of view, the $225 is a totally allowable expense, which, with that 19% corporation tax rate we talked about,
Yeah.
means they save £42.75 in tax.
So just to recap, the director pays out $225 in interest, avoids over $3,000 in dividend tax, and the company even gets a bit of a tax break on top.
Yep, that's the power of this strategy.
So I'm sold. How do I actually put this into practice?
Well, the key takeaway from all of this is that it's not just a nice charging. To have charging interest properly, it's actually just part of running a tight ship financially
Right.
and staying on the right side of the tax man. The first thing, and this is so important, is documentation. You need to have a proper written loan agreement that spells out everything.
Okay.
The interest rate, the repayment schedule, the lot.
So no back of a napkin stuff.
No, this has got to be squeaky clean.
Okay. Got it.
Then the next thing is record keeping. You got to be super diligent with your bookkeeping.
Right.
Use proper software, run regular reports.
Yeah.
Make sure you've got a crystal clear picture of the loan balances, how much interest is built up,
Right.
what payments have been made. That's essential for both compliance and for just understanding where you stand financially.
Okay. And then when tax time rolls around, how does all of this get reported to HMRC?
That's the final piece of the puzzle. All the details of the loan, the interest charged,
Right.
it all has to be reported accurately on the company's tax return. That's Form CT-600. Yep. And on your personal self-assessment as the director.
Okay. That makes sense. Now, I noticed in the stuff you looked at, they touched on something called industry impact.
Yeah.
What sort of results are people actually seeing when they do this?
Well, the case studies and reports suggest that it's working really well.
Okay.
Directors are saying they're ending up with more money in their pocket compared to when they were just relying on dividends. And the companies are saying things like, hey, our cash flow is better and our admin is more streamlined.
And this ties back to what our listener was saying about wanting to get a grip on these strategies that can make a real difference to your bottom line.
Yeah, absolutely. It's about moving away from the standard way of doing things, which can be less tax efficient,
Yeah.
and understanding these more nuanced strategies that can really move the needle.
So to help people listening actually put this into practice, what are some top tips for doing this right?
First up, keep a very close eye on your loan balances. Always know where you stand in relation to that 10,000-pound threshold. Second, make absolutely sure your interest calculations are spot on
Right.
and that your records are up to date. And this is perhaps the most important one because HMRC can be tricky to navigate. I'd strongly recommend talking to a qualified accountant. They can give you advice that's tailored to your specific situation and make sure you're ticking all the right boxes.
That sounds like wise advice. Now, in the stuff you read, they had a few frequently asked questions.
Uh-huh.
Let's just whiz through those. First one, is the interest I pay on my director's loan tax deductible?
Yes, it is. As we talked about before, those interest payments you make to your company, they are deductible for the company.
Okay, great. Next one. What's the current HMRC rate I should be charging?
In the material, it's 2.25%.
Mm-hmm.
But remember that can change. So always check with HMRC or your accountant to be absolutely sure.
Okay, always double check. And last one, do I always have to charge interest on a director's loan?
Not always.
Yeah.
It becomes crucial when you go over that 10,000-pound limit during the year. If you stay under that threshold, then the tax situation is different. And you don't need to be charging interest at that official rate to avoid the benefit in kind issue.
Hmm.
The whole point of the interest charge is to sidestep that big tax, specifically when the loan is over $10,000.
Okay, so that clears up those key points. Let's pull all of this together. What's the big takeaway for our listener?
The main message is that if you've got a director's loan that goes over 10,000 pounds, charging interest the right way can give you some serious tax advantages, both for you and your company.
Right.
And by charging at least the HMRC's official rate of interest, you can basically wipe out that benefit in kind tax for yourself.
Yeah.
And bring down your company's corporation tax bill, too.
Yeah.
It's a really smart way to manage your money.
And it's not just about saving tax. It's also about understanding how HMRC works and doing things properly
Absolutely.
so you can stay compliant.
Yep. Proper implementation with all that good documentation and accurate record keeping. That's absolutely key.
Yeah, I mean, if you're listening, I really urge you to think about how this applies to you. If you've got director's loans in place, is what you're doing right now the most tax-efficient way to handle it?
That's a great question. And it brings up another one. Given all this potential for tax efficiency we've talked about today, what other strategies might you want to explore to really optimize both your company's finances
Yeah.
and your own personal finances?
Yeah.
Maybe there are things beyond the standard approach to director's loans and dividends.
That's a really good point. Now, if you want to go deeper on this, the material we've been looking at has some great resources.
Yeah.
You can find more insights on their blog at https://bit.ly/CRIQ. You can book a free consultation to talk through your specific needs at https://bit.ly/book-free-consultation-15.
Right.
You can check out the services they offer at https://bit.lymanmendco, and they've even got their own podcast where they go into more detail on all sorts of stuff. That's at https://bit.ly/HERIQ. So there's loads of stuff there for you to dig into.
And I think the big takeaway is that when you really understand the ins and outs of the tax system, it puts you in a much better position to make smart decisions about your money and potentially save yourself a good chunk of change.
Absolutely. Well, thanks for joining us for this deep dive into directors' loans and interest charges. Hopefully, you've picked up some useful insights and some strategies you can actually put into action.
Yeah.
Until next time, take care.
See you later.